Hey, Larry Berman here, and here's what's on my radar this week. Well, it shouldn't be any surprise that inflation is what the world's focused on, and of course we got updated data this week, and for the most part, it's about as bad as it could be. Um, to top that off, a massive amount of earnings warnings coming out, and so let's dive in to see what's going on here. So after the economic reports came out this week, largely speaking, consumption side of the equation and the retail sales piece. When you look at the components of GDP, remember we've got consumer spending, we've got residential investment, we've got net exports, imports minus exports, and then we've got sort of the non-residential part of fixed investment, and then we've got inventories, and that is a big swing factor. You can see now for the better part of this quarter, but really you can extend into the first two quarters, that it's the residential investment and the inventory numbers that are been the big detractors from GDP. So we know we've already had 2 quarters of GDP. Consumption has held up pretty well, except until now. And you can see this big hit this week as the retail sales numbers came out. And, obviously a real meaningful impact. We're now at the risk of 3 quarters of negative GDP prints. And even if it's not a full 3 quarters, this quarter now, the nowcast is looking to be, a really bad number. So when you get something from FedEx that basically, when asked, are we in a global recession? And the CEO says yes. Well, let's have a look. So looking at a couple of the headlines that hit the tape here today, there's a lot of news stories after last night's, Thursday night's shock to the market. Obviously, FedEx had a terrible day. You see a headline here: FedEx missed worst in Deutsche Bank analyst has seen in 20 years. In fact, we saw a stat today, and we believe this to be true, that in the history, some close to 50 years of the public listing of FedEx, have never seen a day like today. So that speaks volumes. You can see the big price gap here down, and you would say, oh, time to sell it. I actually wrote puts a couple of months ago to buy FedEx down in the 165 level. So obviously it's a little bit below that now. We took some premium, we earned some income. I actually like it here. The reason I wrote those puts months ago was when I look at this chart and go back for the better part of a decade here, I think this 150 area is pretty compelling. Now, obviously it could go lower. There's COVID, there's the shock to the world. But as the Fed was tightening and the world was slowing in 2019, FedEx came down to these levels. I think risk reward here is pretty attractive for a name like FedEx, but it underscores what we're in for in the next couple of quarters, and that is company after company, industry after industry, sector after sector. We're going to hear more of this kind of negative news. So when you look at the systemic importance of FedEx and that it touches so many industries on the distribution channel, to us, we had to take a quick look at some Dow theory here. IYT is the transportation ETF. FedEx, obviously a big part of that. That big move down here relative to the Dow was the impact of FedEx in that transportation index. When we look at, over the last 5 years, outside of this COVID shock in here, there isn't really a massive divergence going on between the transports and the industrials. The narrative is, of course, when you look at the transports, if they're breaking down, it'll lead the industrials, and we look for divergences. And so as you can see here, if we blow up the chart a little bit to get a bit of a closer look here, the relative lows here in the Dow, in the transports so far, even including the big move today. Remember, there was a rail strike. We got a settlement there that impacts this index as well. So, after all is said and done this week, no major divergence here. But make no mistake, we are absolutely, in a bear market and in the very late stages of an economic expansion where the Fed is taking the punch bowl away. We've got quarters to go before that's all kind of realized. So, message here when we get into, bull and bear pick of the week, I'm a value guy. I look for where value is. And so that brings me to BABA and one of the global consumer plays. And listen, I get the narrative about China being uninvestable. I understand China's isolation and how the West is looking at China, especially as Xi and Putin meet this week, and you can see where the alliances are building on a global basis. You can see the bill that came out of Congress this week, where they've passed I don't know, is it $4 or $5 trillion of arms spending towards Taiwan. I don't think that's going to get through the Senate and the White House, so we probably don't have to worry about being policy, but the message is the key thing here. So, China a little out of favor, but we're going to get past the China fifth plenum in October. Xi's going to be elected for an unprecedented third term. They're going to be pulling back a little bit on the COVID restrictions once we get through that. I think the value here is tremendous still relative to a lot of the other big tech names. So I nibbled on BABA today. I've been building a position for months now. We've gotten pockets of strong rallies. I think there's more to come. Ultimately, when this rips from the mid 80s, I could see this being a double at some point in the next couple of years. So for those of you looking for something that you can call quality, if you don't like the China story, I get that. But again, here's a name that I've been nibbling at. In terms of where we're cautious at, we're not as cautious today on the big tech names as we were, weeks ago when things were a lot higher. But let's look at the NASDAQ here. So again, on the rallies, we get very cautious. Now we're getting very oversold. I had some put spreads that we had put on a few weeks ago in August. I actually lifted this week the long part of the put, the 270 put that I was long. We took a nice profit on it. We exposed ourselves to being naked on the Qs at 250. So why are we looking at 250? Well, let's bring up the chart here. And if we look at the COVID bottom and we run our retracements there, that's the area where I start to get interested again in big cap tech. So, possibility of a retest of the summer lows, absolutely. An undercut on technology, but I think that's going to be the opportunity we want to look for. Still cautious there, selling into rallies. But again, from my perspective, we took some profits on the puts we bought and looking to expose ourselves to buying that dip. So I'm calling this my bear pick of the weeks because we're still cautious on technology in general. But, premiums are going up. So from an option perspective, bullish. From a trend perspective, still bearish until we get to retest some of that support. Have a great week, everyone.